There are now a number of property commentators who are suggesting that we're near the bottom of this particular property cycle. And as you'll hear in my chat with Dr. Andrew Wilson in today's podcast, for the last 2 months in a row, he's also found that house asking prices are holding steady or rising. Now, asking prices are a leading indicator. They turn before eventual sale prices do. But as you'll hear in our chat today, they're not the only indicator that our markets are finding a flaw. Regular listeners will know that I have a weekly Property Insiders video chat with Andrew Wilson, and today this is the audio of one of our regular videos. You're also going to hear us discuss the latest employment data, the fact that we're starting to spend less, the Reserve Bank likes that, and what this is going to mean for interest rates. And we're going to talk about the Reserve Bank's apology to those who listened to their forward guidance, to those who paid attention to what they said. And we're going to also talk about the auction market trends which suggest our markets are close to the bottom. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
We're at the end of another month, almost the end of the year, and it's time to see how our property markets performed over the month of November, in fact over the year. And boy have the housing markets had a lot to cope with this year. Floods, health issues, geopolitical problems, federal elections, and the continual barrage of predictions that our property markets would collapse. And despite all those negative predictions getting a lot of airtime in the media, they haven't come true. One of the lessons I learned years ago was that if you read last year's predictions and see how they transpired, you'll never take this year's predictions seriously. I think you should read fewer forecasts and more history, because there's a lot to learn from how the fundamentals of our property markets work. So how have our property markets performed over the last month? That's what I want to ask Dr. Andrew Wilson, Chief Economist of My Housing Market, in this week's Property Insider Chat. Hello, Andrew.
Hello, Michael, and we have come to the end of another month. In fact, we've come to the end of a season. It's been an interesting spring market. It's been a market of revival. I think that is clear. We're not bouncing back with all the energy that is driven typically by lower interest rates and fear of missing out energy. It's been a flattish but consistent recovery in most markets over spring. Of course, we know that we'll peak out as we move through November. December is that month where buyers particularly start to get distracted by the forthcoming holiday season. So we typically do see, particularly auction clearance rates, always ease from those seasonal effects of the end of the year. And it means there's more stock on the market, more choices for buyers. There are fewer buyers, so clearance rates fall away. But that's just that typical seasonal effect of late November and December. But the monthly price data, again, reinforces, Michael, that slow but steady recovery that we've been seeing over November. We had all capital cities reporting higher prices. Now, these prices are asking prices for established houses as listed. So we tend to see some higher results compared to sales prices, which do reflect a more backward-looking environment. So this is a bit more of a real-time environment when we do use those asking prices. And as I mentioned, these are established houses. So it doesn't cover the new house market, which is covered by other modelers of house prices. So let's get to the results. All markets, with the exception of Sydney, were higher over November compared to October. The top performer was Perth, up by 0.6% over the month. But these were modest increases over the month. And I guess we're not surprised at that, given the gradual revival in market activity and rising confidence. Melbourne and Adelaide were up by just 0.1%. So they were basically flat. And Brisbane up by 0.4% over the month. When we look at the annual figures for established asking prices for houses, Brisbane and Adelaide are still well ahead of where they were a year ago. Perth is up quite solidly also over the past year. Melbourne around about where it was a year ago, up by 1.2%. And similarly, Sydney around about where it was a year ago, down by 0.8%. Some more positive, but certainly gradual signs of an improvement over November, Michael. And of course, as I mentioned before, we are now heading into the holiday season where there is certainly a significant decline in activity, particularly activity in the mid to higher price bracket. We would expect to see some seasonal easing in prices over the next month. And when we look at the more volatile unit market, Michael, we had 3 of the capital cities record increases over the month. Sydney up by 2.4%, Melbourne up by 0.4%, and Adelaide, a strong result, up by 4.2%. Brisbane down by 1.6%, and Perth down 0.2%. Similar results for the annual figures, Michael, for established unit prices, asking prices. Brisbane and Adelaide well up from where they were a year ago. Melbourne and Sydney steady, but Perth unit prices are down compared to a year ago, and that's a little different from the house price annual changes for Perth. But it is a small market, that Perth unit market, Michael, so we do get some volatile results from month to month. So overall, I think there's some more positive results here. As you mentioned, those predictions of catastrophic house price falls certainly aren't coming to bear. There's no doubt that it's been an easing market through winter and then a consolidating and rising market through spring, I believe. So the portents are certainly good for next year, particularly given the strong demand that will come into markets from migration, do remain undersupplied. Where will they live? That's a good question. But also we are now getting some more, I guess, significant signs that we may be just starting to see inflation becoming a bit more controlled. And also we may see the interest rate rises peak earlier and lower than many have predicted. And the latest data is reinforcing that likelihood next year, Michael.
Well, before we look into that extra data, Andrew, some people are going to say, hey, but other research houses are showing different figures and property values still falling. So I just want to reinforce what you said. These are asking prices, yes, and history shows that they are a leading indicator. They show what's going to happen a couple of months down the track when eventually those properties that we're now asking a price to sell eventually sell. So this is not a surprise. It gives us a good indication of what's ahead, Andrew.
Yeah, and I think the important thing is that most data models are showing similar trends, Michael, and that's the point, that the trends are all the same. Different methodologies, some use monthly, some use quarterly, some include new houses, some only use established properties, and some use sales prices, which are always incomplete because the data for sales is very much lagging, whereas listings data measures the full market in real time. So that's a more comprehensive view of the market. But nonetheless, all the trends really are showing that, particularly the shorter term trends. And I think it's very important, Michael, that you don't stand on just one methodology in terms of measuring market activity. It's not just about prices, which can be problematic in the shorter term. It's also about other factors such as auction clearance rates, which we know are a very good leading indicator of housing market activity. And also average days on market can also indicate what's happening in our housing markets. And we know that auction clearance rates and average days on market are clearly supporting what we're seeing with the house price data, with higher auction clearance rates and lower days on market.
Well, the cloud hanging over our property market has been lack of consumer confidence. Yes. And that's a lot been related to rising inflation and rising interest rates and not knowing when it's going to end. But there are some pointers now that maybe the Reserve Bank is going to slow down. More recently, finally, retail figures showing that the interest rate rises are starting to affect how we're spending, Andrew.
Yeah, very interesting times. The latest data, Michael, of course, from the ABS is the preliminary retail sales data for October. It shows the first fall since December last year in retail sales turnover. Seasonally adjusted data. And of course, that data last year was affected by lockdowns. It's the first real sign, a fall of just 0.2%, but a fall nonetheless. And numbers are still very high. Let's be clear here. And certainly retail spending is well ahead of where it was at the pre-COVID levels. But nonetheless, it's got to start somewhere, Michael, and it's the first sign that interest rates are having an impact on consumers. And that'll be something that the Reserve Bank will be happy about, because it shows that their policies are doing what it's supposed to do, and that's to stop people spending, to stop creating increased backlogs in terms of supply matching demand. And I think it's interesting, Michael, that before even those retail sales were released, perhaps we could start to speculate that interest rates would peak earlier and lower than predicted. The Reserve Bank, of course, over the past 2 months have only increased, and I mean only in a relative sense, by 0.25%, following that raft of increases by 0.5%. I think it was a bit of a shock when we did get that 0.25% increase over October. Most were expecting another 0.5%. That was followed up by the Reserve Bank in November, increasing again by 0.25%. And when we read the minutes, the latest minutes from that November meeting, Michael, I think it's instructive that the Reserve Bank mentioned that it was prepared to leave interest rates on hold for some time, or on hold, to wait and see the impact of rates on the economy. I think the reason we've had lower increases over the last 2 months than the previous periods was that the Reserve Bank was recognising that it has a lagged effect, interest rates, and that it didn't want to push rates up too high with a risk of cracking the economy, which of course is performing spectacularly at the moment. And I think that the mention, which they did in the latest minutes, that they're prepared to leave rates on hold was perhaps a signal to markets that don't be surprised if we don't move interest rates either over December or perhaps over February. Of course, December is the last month that the Reserve Bank will be acting for the year, and typically that has a bit of a non-effect, similar to the housing market. People are distracted, so changes in interest rates can really pass through to the keeper. But I think that the Reserve Bank is signalling that it's happy at perhaps the level that interest rates are at, that it might wait and see. I still think it's an outsider, don't get me wrong, that they put it on hold, but I think that there's now an increased likelihood that rates may be left on hold over December or February, given that retail sales data is heading in the direction the Reserve Bank wants it to. And overseas is still working in our favour. We could say the price of oil has certainly stabilised just above $80 US a barrel, that $130 US a barrel at its peak earlier in the year, which of course was driving inflation. And the interesting thing out of the US is that inflation fell for the second month in a row over October in the US, and it's not that far above us now. And they have certainly more significant problems in terms of higher wages growth, which is fueling inflation. So look, a couple of signs just emerging now that can give us a little bit more confidence in terms of the outlook for inflation and interest rates, Michael.
One of the things that surprised me over the week was the Reserve Bank Governor, Philip Lowe, apologised to Australians who took out debt based on the bank's flawed guidance. He said that rates wouldn't rise until 2024, and his words were, certainly he's sorry if people acted on what they'd said, and he now regrets that they've done so. Andrew, he was speaking in front of a Senate committee, and he said he was very glad that workers are now receiving higher wages, and he didn't think that increased labour costs would go on to give that wages price spiral that we experienced in the 70s. So the Reserve Bank did something that I haven't heard him do before. He actually apologised, but he said it was the right thing to do at the time. Looking back, he should have maybe chosen different language.
I thought it was extraordinary, Michael, and I thought it's been a long time coming, and the Reserve Bank has form here. It is not just about their predictions that rates wouldn't rise until 2024. They also made mistakes with their forward guidance back in 2016 and 17 and 18, and created policy decisions from that were harmful to housing markets and our economy, in my opinion. Of course, during that period, the Reserve Bank was telling everybody who wanted to hear that the next move in interest rates would be up. And of course, that was completely wrong in terms of what actually did happen with that sharp declines through the back end of 2019. Now, those predictions from the Reserve Bank of higher interest rates worked their way into policy positions in terms particularly of APRA, the risk manager for the banking sector, who restricted credit to investors on the back of those Reserve Bank predictions of higher interest rates. They felt that that was a risky environment for investors, higher interest rates. And of course, that credit squeeze on investors has lasted really until the beginning of 2021. And it has, in my opinion, resulted in a chronic undersupply of rental properties, with a lot of stress now on tenants having to pay higher rents because of a shortage of rental properties. So maybe the Reserve Bank should also apologise for its problems in its forward guidance that it made previously in regard to its predictions of higher interest rates. I think this is quite extraordinary. It really does reflect the culture of the Reserve Bank in being, I think, a little bit fast and loose with its predictions. And also the Reserve Bank has had a real focus on the housing market. I think that this bank will be characterised by its focus on the housing market. And of course, its predictions in terms of house prices, just as its predictions on interest rates, have been completely wrong. Again, as we've discussed here, forward guidance, shouldn't be in the realms of the Reserve Bank, putting forward its predictions, and it can only lead to not just, erroneous policy outcomes, but stress in the community. And I just think this is quite extraordinary. But Michael, this has been a long time coming. Reserve Bank has form with these problems, not just the latest ones, but as I said, going back to previous predictions, and also in terms of its seemingly obsession with housing markets. I thought that the Reserve Bank governor at one point was asked last year, I think, in regard to or earlier this year, where house prices were going to go. And then he responded by saying, we shouldn't give forecasts on house prices because, that can be very dangerous. And then he went ahead and gave some forecasts.
Yes, that's right. Yes, I forgot about that. That's right. And then he said, even though I'm saying it, it's not a forecast.
Yeah, and then but this isn't a forecast.
That's right.
Anyway, we move on, I suppose, but we need to do better than that. This is a very important part of our economic process, is the Reserve Bank, and we are in very uncertain times in terms of inflation. And we need to get it right, and we need to have the people there who can get it right.
Well, another factor affecting our economy, Andrew, is unemployment employment figures. And unemployment figures kept dropping. It eased to 3.4% in October from 3.5%. Employment rose. Andrew, it seems that the 7 consecutive rate hikes totaling, 2.75% so far haven't dented the job markets, and wages growth went up slightly, represented by the wages price index.
There's a lot of good news around, Michael. I think the good news is sort of working its way through all the doom and gloom. That's why our housing markets have picked themselves up and are sort of shaking off all the predictions of crashes. I think that the strong economy is driving that. If we look at the capital city unemployment rates for October, Michael, they are just spectacular. We can see that basically everybody's got a 3 now in front of it, all those capital city markets. And if we look at the Sydney unemployment rate, capital city economies, the Sydney unemployment rate is now at 3%, Michael, which is quite extraordinary. In fact, the male unemployment rate in Sydney is below 3% now. Full-time unemployment in Sydney for males is below 3%. I shouldn't have to say this, but this is a record low. In fact, we've gone through a period of record low unemployment. First started being modelled back in the early 90s, so we're not going back as far as the national data. But certainly a 3% unemployment rate is unheard of, Michael, in Sydney, and similarly in the other capitals. And that's why we're feeling pretty good about ourselves, Michael. And we've also seen wages, I think, picking up quite reasonably, certainly not at the levels. Our wages growth is just over 3% now. The US and the UK are over 5%. That's why they have bigger problems with inflation. And our unique wage setting system, which relies on those annual reviews, enterprise bargaining, has held us in very good stead in these inflationary periods. And let's just hope that governments find the wisdom not to fiddle with a system that is clearly working and working where we really need it and when we really need it to work.
Andrew, you carefully watch the auction markets and report them before most other do every Sunday on LinkedIn and on Property Update. And I like the way that you actually separate houses and units compared to just the general reporting others do. We've finished the spring auction markets now. There's still a couple of weeks of auctions happening, but as you said already, there are some distractions in December. The spring auction markets gave us a good indication of what's likely to be ahead, how buyers and sellers are feeling.
Yes, Michael, we had the last weekend of spring, of course, last weekend. Sydney market numbers were up substantially. Of course, the weekend before, Sydney had produced its first 70% clearance rate since March, and the trend has clearly been upwards in Sydney. So a good result the previous weekend, but within 100 extra auctions, I think it was starting to creak a little bit, Michael, with more choices for buyers and those distractions we've discussed coming through now, as they typically do at the end of November and into December. So clearance rates were down in Sydney into the mid-60s. Similar in Melbourne. Melbourne's really been a very consistent market through spring with those mid-60 clearance rates, with some still healthy numbers of auctions coming through. Brisbane up a little bit, but we know the Brisbane market can be quite volatile, and we're not getting a lot of reported results coming through in Brisbane at the moment, Michael, but nonetheless still what we call a typical Brisbane result. Adelaide up a little bit following a weaker previous weekend, and Canberra down, but markets are just starting to think about having their usual end-of-year pause, Michael. But I think that, when we look at the trends, and we can look at the trends for each of the capitals over the monthly period, we can see how markets have recovered from the winter depths. These are the monthly weekend auction clearance rates for Sydney over November, 67.1%. Once upon a time, that would have been a pretty good result, Michael, but we've been so used to boom and bust environments. But the market is certainly tracking well ahead of where it was, all our markets, particularly Sydney and Melbourne, of where they were during similar previous consolidation periods and periods of low confidence in 2018. When clearance rates in Melbourne and Sydney were in the 40s, low 40s. But we're in the mid to higher 70s in Sydney, mid 70s in Melbourne, down just slightly over November compared to October. But you can see that's been a very consistent market. The Melbourne market, Michael, again, just tracking in those mid-60s. Brisbane up and down a little bit, as we said, following its very strong auction boom earlier this year and last year. It's moved back into being more of a what we would, describe as a normal Brisbane auction market. Adelaide's been the leading performer, down a little bit over November compared to very, very strong results earlier in spring, but still certainly a seller's market in Adelaide. And the Canberra market has also just started to ease after, but still in clearly a revival mode compared to those winter results. So again, those auction clearance rates and their trends, Michael, give us another indication of where our housing markets have headed. We've been describing this through the winter and spring period. We can clearly see the revival there. It's not a surge. It's just a consolidation of confidence moving back into the market. But I think the growth will start to occur next year, certainly on the trends. And given our expectations are better in terms of interest rates and inflation, we still have the drive from migration to fuel housing markets, which I think we're already starting to see some early signs of. So we await our final auction results over the next couple of weekends.
Well, we'll be back each week with these Property Insider chats and keep reporting how the property markets are heading. But I think there's going to be some property pessimists who are going to be disappointed as we finish off this year that once again their forecasts were very, very wrong.
The data has shown us that for the last couple of months, Michael. And of course, it takes a couple of months to consolidate the trend, and just so it's not just a one-off. And and we need a number of the data points to also consolidate.
And of course, the thing we haven't mentioned today, but we mention regularly, is what's happened to rentals as well. The rental markets are experiencing a crisis which is causing rents to shoot up to levels we haven't seen for a long time.
And we'll have the rent report out next week for November, Michael, so it'll be interesting reading again.
Fantastic. Looking forward to catching up with you next week then, Andrew. Thank you.
Thanks, Michael. Good to chat.
Just following on with my chat with Andrew Wilson a couple of minutes ago, I just wanted to give you my thoughts that I believe that there may only be one or two more interest rate rises, and that inflation is going to peak at the end of this year, but the results won't come through till early next year. But I think the world is starting to realise that we are near the peak of interest rates, that we are near the peak of inflation, and it seems with the many people now inquiring at Metropole that investors and home buyers are deciding to get into the market. They're just accepting the market as it is at the moment. Now, I'd agree with that, because over the last year, emotion has really been clouding a lot of people's investment decisions. And I can understand that. We experienced a wild time in our economy and the property markets, and there was the continual conveyor belt of negative messages. There was problems with decreased affordability, and property values were falling. Mortgage rates were rising, and the media was full of stories about further falls. And of course, that had to dampen consumer confidence and buyer enthusiasm. Of course, there was lots of good news in the markets as well, but the media didn't spend as much time on that, like our booming economy and our employment rates that were high, and for investors, the fact that capital city rents continued to tighten and record low vacancy rates meant rents kept going up. But it's important not to let emotions get involved in the very big investment decisions you make, like buying a property. Now, for most people, they do this emotionally. They see buying an investment property as the strategy. I'm just going to buy a property. No, it's actually not. In property investment is a process, and the property you eventually buy will be the physical manifestation. Well, it should be the physical manifestation of a whole lot of decisions you've got to make, and you've got to make in the right order. In other words, you need to plan, because creating wealth through property doesn't just happen. It's the result of a plan. And if you want to take advantage of this small window of opportunity that's left in the property market at the moment, before it turns and before other people realise, why not have a chat with my team at Metropole? Now, I know for many of you listening to this, it's getting close to the end of the year, but still, go to metropole.com.au. I'll leave a link in the show notes and have a chat with one of my team, because while the property markets will create significant wealth for many, over the long term, statistics show that most of the people who get in property investment never get past their first or second property. In fact, 92% don't. And we know that 50% who buy an investment property sell up in the first 5 years. So, as I said, attaining wealth doesn't just happen. It's the result of a well-executed plan, and that's what we specialise in Metropole. So while we do help our clients grow their wealth, pass it on safely to future generations, we help them outperform the markets, we do that by starting off by putting a strategic property plan together for you. And if I could show off, I'm really proud of my team who've won 3 international awards just in the last couple of months, including Australia's most trusted property advisors. So go to metropole.com.au, have a chat with my team and see how we can help you safely grow your wealth so you can also enjoy it and pass it on to future generations.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Today I'd like to share with you a daily tool that the rich use that never occurs to most people. Over the years I've worked with and mentored many successful investors and business people, and I've found that they use this daily tool that most people never think of. Now, we've all heard about, or maybe used, to-do lists. The best to-do lists incorporate daily activities that help you move towards your goals. You've got them set out there. But to-do lists alone won't make you successful. While it's important to get things done, it's equally important to avoid things that actually stop you getting towards your goals. So you've probably never heard of a to-don't list before, but that's what you need. Now, I discovered this little-known secret of most successful people many years ago, and a to-don't list includes things you should never do because they're either time wasters, bad habits, or things that hold you back from being happy and successful with life. Now, my good friend Tom Corley has written a lot about this in his books and combined a bit of it in our joint book, Rich Habits, Poor Habits. But he also says that to-don't lists are just as important as to-do lists. And he's made a list of things that you should have on your to-don't list. He says most successful people fostered accomplishment in their lives by diligently doing certain things every day and diligently avoiding certain things. He went on to say most people, unfortunately, aren't successful in life. They eke out a living and struggle to just get by, unaware that they're engaging in destructive activities on a daily basis that makes their own success impossible. So Tom Corley went on to say they're engaging in these activities that might appear on a typical to-don't list of a successful person. And that would say, don't watch more than an hour of TV today. The to-don't list would say, don't waste time on Twitter, Facebook, Instagram, YouTube. The to-don't list would say, don't envy anyone today. Don't make any impulse purchases today. Don't gossip. Don't gamble. Don't drink in excess today. Don't lose your temper. Don't ignore your family. The to-don't list would include things, according to Tom Corley, such as don't read negative news articles, don't procrastinate, Don't ridicule anyone. Don't hate anyone. Don't smoke a cigarette today. And don't be negative. Now, for those who've got a lot of bad habits, to-do lists are actually more important to them than to-do lists. And you know, in our book, Rich Habits, Poor Habits, which you can get at richhabitspoorhabits.com, we explained that people are going around with one foot on the accelerator and one on the brake. They've got a lot of rich habits, but they've also got poor habits that they've got to get rid of. They've got to break. And that's where a to-do list will help you. To-do lists help keep you aware of things you shouldn't be doing. Knowing what not to do, in my mind, is just as important in achieving success as knowing what to do. So, what would be on your to-do list? When you ask yourself that question, only then will you become aware of the daily habits that are constantly pulling you backwards. To-dos, while a great tool to help you improve your chance of success, are only going to get you halfway there. To-don'ts will get you the rest of the way to your success. We're living in interesting times, aren't we? But twice a week I'll be back with the Michael Yardney podcast to help give you some clarity and direction. But if you've got some benefit from this, please help somebody else understand what's ahead. On every podcast app where you're listening to this, there's a share button. On iTunes, there's a couple of buttons down the bottom if you just press it and share it with somebody, or just tell somebody about the Michael Yardney podcast, or why not tell the world by leaving a review? I'd really, really appreciate that. Now, I'll be back again real soon, but you can catch me on social media. Just look for Michael Yardney. And why not subscribe to my YouTube channel so you can get the regular weekly Property Insider chats with Andrew Wilson. Just look for Michael Yardney on YouTube or propertyinsiders.info. You can also join my private Facebook group. There's lots of places to find me. The Facebook group is Property Update Private Facebook Group. As I said, I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?